You're listening to the Infinite Banking Mastery Podcast. Did you know that you could build a tax-free pool of wealth that's liquid and accessible all your life while building your retirement nest egg? Gain full control of your financial future and stop relying on the government and banks. The wealthy have already discovered this wealth-building secret. Now it's your turn to get financially secure without following the conventional wisdom that keeps you in debt to banks. Now here's your host, Valerie LaRocque.
Hello, and welcome to the Infinite Banking Mastery Podcast. Thank you so much for being here once again. I appreciate you. Hope that you've had a great week and are enjoying some lovely fall weather where you are. I did just speak to a good friend of mine in North Dakota who has snow already. They are already getting inches of snow. And I thought, how sad. They didn't get to enjoy the beautiful fall leaves, the fall colors. So I hope where you are that you're able to still enjoy some fall weather before the snow hits. Today, I wanted to talk about what life insurance companies invest in. A lot of people will have that question. Where is the money going? When I put the money in the life insurance company, how is it being invested? Well, life insurance companies do invest in a variety of different ways. One of the biggest ways that they invest would be into bonds. Bonds are one of the biggest areas that they would invest your money. Of course, that is if you are not already using it, because you do have first rights to the money inside of your policy. You have the first ability to borrow against it before they do anything with it, like invest into bonds. So they like bonds because they're one of the safest ways to invest the money and know what's going to happen in the future, because bonds provide a more predictable future cash flow. Some people might be asking, what are bonds? Well, a bond is a debt instrument. And so the government might issue different kinds of bonds as a debt instrument for people to invest in, knowing that we're going to get back a certain amount, a stated amount. And so you can purchase these bonds for different timeframes. And life insurance companies like 30-year bonds. They like pretty long ones, bonds that are way out, because they know they can count on that money. They know in 30 years when that bond matures, they know exactly the amount that they will get back. And that's what they are interested in. They want to know what's going to happen later on. They want to be able to count on what's coming in from those investments, because insurance companies are in it for the long haul. They aren't just looking the next few years, what's the volatility in the market going to be, this and that. They are looking 100 plus years out, because they are trying to outlive the death benefits that they have to pay. They are trying to be there for the families that trusted them to be able to take care of their families. And so they are looking 100, more than 100 years out. They need to be able to count on that money that's going to come back to them at these different times. So they need to be really conservative with the funds that they receive. So the majority of bonds that life insurance companies purchase are government bonds. They also do buy high-grade, high-quality corporate bonds, because these two are the safest bonds that they could purchase. Another area that life insurance companies will invest is in real estate. A pretty good portion is invested in real estate, actually, and primarily commercial real estate. The real estate that the insurance companies like to purchase are things like industrial buildings, such as office buildings or retail. A life insurance company might do something like, say, go out and buy the Empire State Building in cash and then have rental income come in, and they have that rental income from the leases from those businesses that are renting the building coming in on a regular basis. So they have that cash flow that they can count on. But they do invest in real estate in a variety of ways. People might think that they invest heavily in the stock market, but no, not so much, not really. Although they do hold some equity securities, that's not a huge part of their portfolio. The stock market is just too risky. Again, they need to have something they can count on, something they know is going to be there in 30 years, that when it comes to maturity, they know the dollar amount they're going to receive. So they do have a little bit of money into the market, but just not a lot, and not as much as a lot of people would expect. Insurance companies need to know with a pretty high degree of certainty that they're not going to have an unsustainable loss in any given year. In addition, a portion of the equity investments, such as common stock and mutual funds, a portion of that is often invested in preferred stock, which perform more like bonds than common stock do. Some companies will also invest a small amount of the money into liquid short-term investments like CDs or money markets. But another asset that they have on their books, as I mentioned earlier, are the loans on the insurance policies, your loans. And so as a policyholder, again, you are co-owner on your policy and you have first rights to that money. The life insurance company does need to make a certain percentage, of course, so that they can pay their bills, pay their employees, pay the death benefits, pay the advisors. They do need to make a certain amount of money. And that's why they charge the rate that they do for borrowing against your policy, because they need to be able to earn that much money to be able to take care of everything that they have to pay for. So again, the life insurance company needs to make a certain percentage to be able to cover all their commitments, the death benefits, make sure that they can cover your death benefit, and they will get that either from an outside source, an outside way of investing into one of the things I mentioned, and there may be some other things too for other companies, but these are the majority. Or they will get that percentage that they need from you borrowing against your policy. I've heard before as well, more than once, talking to life insurance company executives, that they have so much cash in reserves, they're looking for things to buy. They're looking for what they can put that money into, which is great because, again, life insurance companies are not like banks. They are not creating money out of thin air, and they have that money on reserve as opposed to banks who are creating money and have very little on reserves. Life insurance companies have a ton of money on reserve. They are not doing any fractional reserve banking. That is a win. Some people do get a little tripped up on this concept, borrowing against a policy, the details of paying their policy back for loans that they took, and just understanding that whole process. How am I making money when I'm borrowing against my policy? So I do have some nice fancy calculator software to help you understand this. The software is called Truth Concepts, and you're able to look it up, purchase it if you want to. It's just really financial calculators that you can see all of what's going on at once instead of plugging it into a financial calculator. But it does also have a lot of other cool features and cool ways to calculate things. But yeah, when my clients are confused about borrowing against their policy and they starts to get a little hazy, this is always something I want to make sure is crystal clear to my clients. So I will pull up these calculators to help them understand what is happening when they are borrowing against that policy, what's happening with their cash, how are they still able to have their policy growing when they are doing that action. A lot of times people will say, oh, I should pay myself nothing back, or I shouldn't have to pay the insurance company anything because it's my money. But of course, you do want your insurance company to be profitable. You want them to make money because that money that they earn comes back to you in the form of a dividend. And you want your insurance company to be able to be a successful business so that they will be there to pay your beneficiaries when you eventually graduate and leave this earth. And this is all something that, again, I'd be happy to make more clear to you. If you would like to work together and would like to reach out, we can go over this so you understand it more fully. It's more clear in your mind. So the good news is that when you use your policy, when you borrow against it, when you implement and take control of the banking function in your life using a whole life policy, a dividend paying whole life policy issued by a mutual life insurance company, your loans are accounted for on their books as an asset. And that is terrific. So that's all I have for you today. Just wanted to clarify what the life insurance companies are doing with your funds when you send them in and when you're not borrowing them right away. If you'd like to connect, if you'd like to chat with me and find out how this system could work for you and your family, how you could implement the process of infinite banking in your life, I would be happy to talk with you. Please reach out to Valerie at alphaomegawealth.com. I look forward to speaking with you. Thanks again for being here, and I hope that you have a great week. Thank you. Take care. Until next time.
This is thepodcastfactory.com.